So another company straight away. Let's look at TWX, Time Warners. Also, company has their parks. Now, from quality perspective, this company, I'm not going to in the details. 38. So it's strong 3, very close to 4. Where it's losing, we can see that it didn't grow that much. Their sales for the last 5 years, it was actually negative, although earnings were growing. Their sales and earnings, you see sales they are not stable. Earnings look good. So, and they have a prediction that they're going to make money. So in any case, it's lost here. And again, it lost. Let's have a look. Debt as high as with Foxa, right? So it's 39%, so nearly 40%, so much higher than Disney industry. So it's bad part again, okay, but profit increasing. So let's have a look at the value line report. I have it here just quickly. So that's what we can see that that's where there was a drop here in 2013, 2014. Okay, slightly drop. From earnings perspective, it's growing. But again, it's always good to have a look at the net profit, and we can see that it was 3.89 billion, and here's 3.7 billion. So it's actually dropped in price, in earnings. But because they are buying shares, right? So earnings per share, they're still the same. And the debt is 23 billion. So it's more than Disney. Disney has 22 total and capitalization 61 billion, whereas Disney has 150 billion. So in this parameter, Disney looks like more stable. But again, value line project that is going to move at higher pace, 20% compare with Disneyland. But again, remember always that it's just their projection. So you have to make your own decision, okay, in this particular case. And when we look at try to identify our prices ranges, okay, so we can see that the price might range based on their multiples for the last 5 years, price earning ratio. Okay, we see same way as we do with Disneyland. We can see between 53 and 64, that's what time to buy. Between 64 and 75 we hold, and above 75 we sell. And the current price is 75. So it's actually at the highest hold level. So it's definitely stay away from this company. Don't enter the position because it's not a good investment. And we look at here, so we can see it's below 40, so it's not a perfect time to enter this particular company because your risks about the same as reward. Okay, and similar story if you go for technicals, that's probably was the best time to buy when it was 57. Okay, what's our range was from 53 right to 64. So uh, that's where it was time to buy. Okay, $58 here in January when it dropped, and after that it grew up 75. So if we see that it drops down, even it might continue to do this rolls back to 84 following this trend. So it's easily can do that. But if something happens, it might break through. So next level would be 69. If it breaks through, next would be about 63, right? So you have to pay attention to that, especially that the company doesn't increase their uh, like profit right now. So they increase profit per share, but their growth slowed down. So pay attention to that. So out of these three companies which we have, right, all of them they're pretty good companies, but Disney wins on all fronts. Okay, yes, Fox is more undervalued than Disney, but it has a reason for that because it's losing their earnings compared with Disney. Okay, put a green tick if it's clear about this part. And if yes, I will go ahead and show very interesting company. Okay, so which is in my case shows how people react on something nice and good. Okay, and that there is no logic in investment.